I try to keep my young looks for as long as I possibly can. Yeah, thank you for that. Okay, we're still on the first slide. How do I get to the next one? Yes, that is also working. Just to take a short step back for those of you who are not completely familiar with MiFID. This is usually a difficult step because I've spoken to audiences where I thought, oh dear, I've said something that was too technical, and then the first question was, yes, but what will happen to the Article 2(1)(d) sub C in the recently leaked presidency text? So then it turned out that I was actually, sort of on the dot there. But the main objectives from MiFID, so also better to understand where we're coming from with regards to transparency, are mostly to update the existing framework to take into account all the technological and market structure developments that we've seen over the past years. MiFID's only been in force since 2007, but obviously the text had been around for longer than that, and it was based on a market situation that existed even before work was started on the text. So it essentially reflects Europe in around the year 2000, and obviously the markets have moved on from there quite considerably. Another crucial element that we need to encompass is the G20 commitment. The G20 commitment to have all derivatives on central trading facilities and have them centrally cleared where appropriate by the end of this year. That last bit is going to be slightly tricky, I think, but EMIR is looking to deliver at least on the central clearing aspect, with MiFID trailing a little bit behind on the central trading. So the G20 there have also very much brought derivatives into focus of this MiFID review, which we're presenting as a comprehensive package. So it's very much the Commission's intention that both MiFID, the recast, and MiFIR, together with the market abuse regulation and the criminal sanctions market abuse directive, all enter into force on the same day, including all the level 2 measures. So as we've just heard, the Parliament is very much delivering on its very ambitious timeframe to have agreement in the second half of this year. Also, the European Council in March has announced that it intends to have full agreement on the text by the end of this year, so in December. That means that when the Parliament have actually agreed amongst themselves what their position is, the Council will also have to do so fairly shortly, so that we can move to trilogue, in which not only the Member States amongst themselves and the MEPs amongst themselves, but the MEPs, the Member States and the Commission all get in a room together and come up with a final text that everyone agrees on. And then we will have to work on all the level 2 measures, which will also have to be ready before all these rules can come into effect. Now, in the Commission's view, this should be somewhere around the end of 2014. We think this is rather an ambitious timeframe, but also we're very conscious that in the Parliament there are a number of amendments being discussed to move these deadlines even earlier and have all the rules apply a year after they actually enter into force. So that would mean that there will be a lot more work, not just for us, but also for industry to respond to ESMA consultations and to contribute to impact assessments to make sure that we actually get all these calibrations right in a fairly ambitious time frame. Crucially, what MiFID intends to do is present a framework that encompasses all trading in financial instruments, so not just equities, but also bonds and derivatives. For that, we introduce the organized trading facility, because we consider that not all markets are ready to be traded in a completely non-discretionary way on multilateral trading facilities as they exist today, that there does need to be some form of discretion to be allowed to the operator of the OTF, but that at the same time all these venues will have to play by the same rules, so that the same pre- and post-trade transparency requirements apply to an instrument regardless of where it's traded. And with an important caveat, because we consider that the regulated markets, MTFs and OTFs, are in fact platforms in the G20 sense of the word, in the sense that they actually have, in the sense that they actually bring two people who want to trade together, whereas we consider that the systematic internalizer is essentially a broker trading OTC, so that, because the broker is always the counterparty to the trades, it's not actually bringing two clients together, it's just the broker trading with its clients. So we consider that the SI is not a venue, and for that reason also there are different rules which apply to them, which are not just rules about transparency, but which are rules that actually oblige them to trade under certain conditions. Whereas on an OTF or another venue, what you see is really transparency. It means people are out there to trade. But an SI, you're actually telling them under which conditions they have to enter into a transaction with a number of their clients. On transparency, the main ideas, and this intuition I think is very strong. If you have pre-trade transparency, as an investor, you know where to go, you know where to get the best price. It helps to see if trades are being routed to the appropriate venues, and it allows firms to ensure that they are getting the best price for their customers. And this is pre and post trade together, because ex post you can see if your broker is actually getting you the best deals, but also the broker needs pre-trade to be able to see where to get the best deals for their clients. Crucially, the transparency rules in the Commission proposal would get expanded from not just equity but to bonds and derivatives, with improved ESMA coordination of what these waivers are to be. That said, in general, the Commission doesn't like waivers very much, so we're critical of all of them and very happy to discuss which ones and in which forms should be retained, not just for the new rules that will have to be drafted for bonds and derivatives, but also for the existing waivers that apply to equity today. I think the only one that everyone agrees is a very good idea to have is the large in scale waiver. The only question crucially there is what is large in scale, and does large in scale mean that it's large compared to the normal size of the market, or do we mean large in the sense of retail versus wholesale? In the Commission's view, a large in size order is something that's large for the market as a whole. So we don't just envisage these pre- and post-trade transparency rules as being good for retail investors. We consider that they are there for the market as a whole, and should benefit everyone, not just small investors, but larger investors as well. As for non-equities, crucially, and this is also going to be presumably most of the work that is going to have to be carried out following the adoption of these proposals for the level 2 measures, is going to be calibrating these requirements to individual markets, presumably even individual instruments. Because crucially, in the bond market, not every country or company's debt is going to be equally liquid. Trading is not going to happen in the same way. There will be differences in the liquidity of the futures market, and for derivatives even more so. Some are going to be very highly standardized, some are going to be basically bespoke products traded amongst very sophisticated investors, and the ones of those that are going to get caught in these rules do need to be able to continue to be traded, because the obligation of introducing these requirements is not to stop trading, but to ensure that trading can go on, except in a transparent way. Similarly, following the calibration to types or even individual instruments, also the waivers will have to be calibrated appropriately to actually match with the numbers and other elements of the transparency requirements that are going to have to get calibrated. And the same goes for delayed disclosure, which is going to be especially important in the non-equity sphere. Because crucially, when you discuss these issues, some people are going to argue that when you have post-trade transparency for the bond market, which is only delayed by 1 hour, that is essentially already pre-trade transparency. Even though the trade has already happened, it contains enough information for other market participants to be able to benefit from it. So also, when calibrating these rules, we are going to have to take into account what the appropriate timeframes are for each market, not just the sizes, but also the timing. And then on post-trade, I think there was a general expectation when MiFID I came into force that the market was going to be able to deliver on a consolidated tape, which so far has not quite happened. There are some people out there who say that they actually do have a consolidated tape to offer. It's just really, really expensive. So that, to my mind, that doesn't really count. What we want is a consolidated tape that's usable and available to everyone, and not just as a bespoke product that'll cost you a lot of money. In the Commission's proposals, our approach isn't simply limited to waiting for industry to deliver this time. There is some logic behind going for the commercial solution, which is that we consider that one of the main obstacles to industry coming up with a consolidated tape, apart obviously from all the vested interests that keep people from actually doing so, but one of the main practical obstacles is data quality. And what we hope is that by increasing data quality and harmonizing the way data are reported across Europe, it'll be more economical to be able to aggregate all these data and for industry to come up with a consolidated tape on a commercial basis. But at the same time, our proposals also contain a very strong review clause allowing the Commission, if after 2 years this does not happen, to come up with new proposals, and not just an analysis, but also actually to come up with proposals to mandate a consolidated tape after entry into application of MiFID. So I think on a general note, to get back to the theme of today, crucially the question, how are we going to have pre and post trade transparency, is going to be largely a level 2 question. Now, what is very important is that we ensure that the empowerments and the considerations that we put in place at level 1 for ESMA to come up with advice and for the Commission to draft delegated acts actually contain all the relevant criteria and the ways in which those are to be taken into account when coming up with these level 2 criteria. But that it is going to be for level 2 to go through the market instrument by instrument, or type of instrument by type of instrument, however granular needs be, and actually fix the numbers, ensuring that the markets will be transparent and continue to work at the same time. So thank you for that.